In March 2023, a bank with $200 billion in assets collapsed in 48 hours. Not a tiny bank, not a dodgy operation. Silicon Valley Bank, one of the most well-known financial institutions in America, gone in 2 days. And thousands of businesses woke up the next morning unable to pay their staff. Their money was just stuck. Most people never think about whether their money is actually safe in the bank. We just assume it is. We were told it is. But the truth is more complicated and more important than most people realize. Today we're going to go through exactly what makes your money unsafe in a bank, how the system is designed to protect you, and where those protections actually run out. Let's start with something most people find uncomfortable when they first hear it. The moment you deposit money into your bank account, it is no longer your money in the way you think it is. Legally, you have handed that cash to the bank. In return, the bank owes you that amount back. But the actual physical money, it's gone. Banks operate on something called fractional reserve banking. They take your deposits and lend most of it out to other people, as mortgages, car loans, and business loans. They only keep a small fraction of it sitting in reserve. Think about that. If you have $10,000 in your account, your bank might only be physically holding $1,000 of it at any given moment. The rest has been lent out. It exists as someone else's mortgage or someone else's business loan. This isn't fraud. It's how every bank in the world works. And most of the time it functions perfectly, because not everyone tries to take out all their money at the same time. But what happens when they do? A bank run is exactly what it sounds like. People panic. They rush to take their money out all at once. And because the bank only holds a fraction of deposits in reserve, it can't pay everyone back. What makes bank runs so dangerous is that they are self-fulfilling. Even if a bank is perfectly healthy, if enough people believe it's in trouble and rush to withdraw, that belief alone causes the collapse. The fear creates the crisis. This is exactly what killed Silicon Valley Bank in 2023. Word spread on social media that the bank had losses on its investments. Tech founders started messaging each other. Within hours, billions of dollars in withdrawal requests flooded in. The bank couldn't cope. By the next morning, it was over. And SVB wasn't alone. Within days, Signature Bank collapsed too. Then fears spread to Credit Suisse in Europe, one of the oldest and most prestigious banks in the world, which had to be rescued in an emergency takeover. All of this happened in 1 week in March 2023. So what's actually protecting you when this happens? Most countries have a deposit protection scheme. In the United States, it's called the FDIC, the Federal Deposit Insurance Corporation. In the United Kingdom, it's the FSCS, the Financial Services Compensation Scheme. In Europe, most countries run their own national guarantee schemes. Here's how it works. If your bank collapses, the government guarantees to pay back your deposits up to a limit. In the United States, that limit is $250,000 per person, per bank. In the United Kingdom, it's £85,000. Most of Europe sits around $100,000. For most ordinary people, this is enough. If you have less than those amounts in a single bank, you are very well protected. Your money would come back to you, usually within days, even if your bank completely failed. But the holes in this safety net are real. First, anything above those limits is not protected. This is exactly why SVB was so catastrophic. Most of its customers were businesses with millions in their accounts, way above the $250,000 FDIC limit. Nearly 94% of SVB's deposits were uninsured. When the bank failed, those businesses had no guarantee of getting their money back. Second, the protection only applies to regulated banks. Money in payment apps, digital wallets, or some fintech products may not be covered at all, or only indirectly. Always check. So deposit protection is real, and it works, but it has clear limits. And there are other threats to your money that no protection scheme covers at all. Here's a threat to your money that nobody will ever warn you about, because it happens slowly and silently every single day. Inflation. If inflation is running at 4% a year, and your savings account is paying you 2% interest, you are losing 2% of your purchasing power every year. Your number in the bank stays the same or goes up slightly. But what that money can actually buy keeps shrinking. Over 10 years, that quietly destroys a significant chunk of your wealth. $10,000 sitting in a low-interest account during a period of high inflation could have the real-world buying power of $7,000 or less. A decade later, even though your statement still shows $10,000 or more, no bank collapse, no drama, just slow, invisible erosion. and no compensation scheme protects you from it. The bank is safe from collapse, but your wealth is still shrinking. We said earlier that banks lend out most of your deposits, but they don't just lend it, they also invest it in government bonds, financial assets, and other instruments. And this is exactly what got Silicon Valley Bank into trouble. SVB took billions of customer deposits and invested them in long-term government bonds. When interest rates were low, then interest rates rose sharply. When rates go up, the value of existing bonds goes down. Suddenly, SVB was sitting on massive losses on paper. When they tried to raise emergency funds and disclose those losses publicly, panic spread instantly. The bank run started, and within 48 hours, a seemingly solid institution was gone. The lesson here is that banks are not simple vaults. They are active businesses making bets on interest rates, on borrowers paying back loans, on the economy staying stable. Most of the time, those bets are safe and well managed, but they are still bets. Here's the good news. There are clear, simple steps you can take to make sure your money is as safe as it can be. Step 1. Stay under the protection limit at any single bank. In the United States, that's $250,000. In the United Kingdom, that's £85,000. In Europe, it's around $100,000. If you have more than that, spread it across multiple banks. Each account at each separate bank gets its own protection limit. Step 2. Check that your bank is actually covered. In the United States, look for FDIC membership. In the United Kingdom, look for FSCS protection. In Europe, look for your National Deposit Guarantee Scheme. Any legitimate bank will display this prominently. If it doesn't, that is a red flag. Step 3. Be careful with fintech apps and digital wallets. Some are fully protected, others hold your money in pooled accounts that may offer partial or no protection. Always read the small print on where your money actually sits. Step 4. Don't let inflation eat your savings. Keep only what you need for emergencies in a low-interest current account. Put the rest somewhere that at least matches or beats inflation. A high-interest savings account, government bonds, or a diversified investment account. Step 5. Don't panic during banking scares. In 2023, despite the collapse of SVB and Signature Bank, regular depositors under the FDIC limit lost nothing. The system worked. Panic itself is one of the biggest risks. Staying calm and knowing your protections is worth more than any financial product. None of this is complicated, but most people never do it because they never thought they needed to. Your money in the bank is mostly safe, but mostly is not the same as completely. Banks lend out your deposits the moment you put them in. A bank run can bring down even a healthy institution in hours. Deposit protection is real, but it has limits. And inflation silently erodes your savings every single year, whether the bank is healthy or not. Understanding these risks doesn't mean you should stuff cash under your mattress. It means you should make smart, informed decisions about where your money lives and how much of it is truly protected. If you want to go deeper on any of this, fractional reserve banking, how the FDIC actually works, or the full story of what happened in March 2023, drop it in the comments. I'll make those videos. Like the video if this made you think differently about your savings. Subscribe if you're new. And share this with someone who thinks their money is 100% safe, because now you know it's a little more complicated than that. See you in the next one.